In Chapter 11, we're going to conclude our discussion of fixed income securities by looking primarily at bonds. We're going to really look at three things. We're going to talk about interest rates in general through something called the yield curve. We're going to talk about how you calculate the rates of returns on bonds. And then in the end, we're going to talk a little bit about some strategies and some risk measurements. So the required return on an investment is a combination of three things. It's the real rate of return, that's created by the supply and demand of money. Expected inflation premiums, we understand what inflation is. And then it also includes something called a risk premium. And that risk premium comes from a couple of things. With respect to bonds, it refers to default risk or the risk of the issuer itself, the term to maturity, and any call risk that might be present. So this risk premium has a determining factor, if you will, that's based on the riskiness of the actual security itself. The major bond sectors refer to, what types of bonds are out there are in classifications, if you will. You can buy treasury securities, you can buy municipal bonds, you can buy corporate bonds. And what we find out is that, bonds that have similar types of cash flows and bonds that are similar in other ways but are different with respect to the risk premium are going to have some differences in returns. Just makes sense that if you have a different risk premium, you'll have a different yield on that particular investment. And this difference that we see is something called the yield spread. It's the difference between the yield of one and the next. So treasury bonds should have the lowest yields because they're the safest of all. There will be a marked difference between similar bond issues that are municipal bonds. They'll have a slightly different rate of return. And corporate bonds will even be higher because they have default risk and some other risk factors included that the other two don't. So the yield spread is the difference between these things. So what kind of factors affect these yield spreads? Well, municipal bond rates are usually about 20 to 30% lower than corporate bonds because of the tax-exempt nature in municipal bonds. Treasury bonds have lower than corporation because of the no default risk. So the lower the credit rating, the higher the interest rate, that is the higher the risk, obviously. We'll find out that discount or low coupon bonds are going to yield less than premium bonds, right? The high yield or high coupon bonds. Bonds with longer maturity are going to be generally yield more than shorter maturity, right? Long-term debt is less expensive and you earn long-term debt is more expensive than short-term debt. So again, we know that there are these factors that affect this yield curve. So let's again think about how interest rates come to play. If interest rates go up, we know bond prices go down. There's an inverse relationship between interest rates and bond prices. Now let's also think that every time we use the word price, you can also put in the word return, but you have to switch the hand here. So if interest rates go up, bond prices go down, but that also means that the returns on investments are going to go up. So interest rates and returns go in the same direction, bond prices go in the opposite direction. When inflation goes up, interest rates go up. So if inflation goes up, interest rates go up, bond prices go down, bond returns go up. So there's this relationship between interest rates and inflation, bond prices, and returns. And although it's not a perfect correlation, you can kind of see the relationship here between the treasury yields, 10-year treasury bonds, and inflation rate itself, the consumer price index. And you can see that, they generally move in the same direction. So there is a correlation, certainly not a positive or a perfect positive correlation, but a correlation nonetheless. So how do economic variables then impact interest rates? What if there's a change in the money supply? Well, what happens to interest rates when the money supply changes? If there's a slow increase, right? If there's a slow increase in interest changes, then there'll be a decrease in interest rates. If there's a slow decrease, there'll always be an increase in interest rates. What if the change in the money supply creates a fast change? Well, a fast change is going to have different results. A fast increase in interest rates is going to cause interest rates in general to increase. So we need to understand when the supply money changes, is it going to have an immediate effect that's fast, maybe a fast and big increase or change, or is it going to be a slow? And if it's slow, it's going to work a little bit differently than what we might think it would work. Federal budget, if there's a deficit, we should see increases in interest rates, right? If there's a deficit, it means the government needs money, right? So that's going to cause an increase in the supply. With U.S. economic activity, right? In an expansionary phase, right? People need money. That's going to have an impact on the demand curve. It's going to drive demand up. That means they're going to have an increase in interest rates. How we can measure what goes on within the economy and within interest rates in general is through a tool called the yield curve. And it really has two parts of it. There are actually two things. They both measure the same thing. One is a graph and one is a table. The term structure of interest rates gives us the relationship between interest rates and time. And the yield curve is a graph of that relationship. So what we have here is something called a yield curve. And you can see down here is term to maturity, and up here we have the yield. And as we can see in this red line, that as maturity goes on, longer term bonds tend to have higher yields. This is the kind of yield curve we would expect to see almost all the time. However, from time to time, there could be a downward sloping curve, which means obviously what? That lower interest rates or lower yields are attributed to longer term bonds. And what we want to talk about over the next couple of slides, how's this curve created, or how are interest rates created in the marketplace? So there are three theories we're going to talk about. We're going to talk about expectations, where investors are looking to the future to try to figure out what's going to happen in the future with interest rates. We're going to talk about liquidity preferences, and we'll also talk about market segmentation, the supply and demand for bonds. So let's start with this expectations hypothesis. The shape of this yield curve is based on investors' expectations of the future. So if investors expect rates to go up, they'll only purchase long-term bonds if those long-term bonds are going to offer higher yields than short-term bonds. Therefore, the yield curve has to be increasing. So let's kind of think our way through what that might actually mean, though. This is a picture. The yield curve is a picture of Treasury securities over time. So Treasury securities are the real rate of interest, or the yields is the risk-free rate, and the risk-free rate is essentially the real rate of return plus inflation. So another thing that this yield curve shows us is that if this is an upward sloping curve, we have expectations that future interest rates are going to go up. the yield curve, or excuse me, the real rate of return doesn't change dramatically over time. It's fairly stable. So what is changing if the risk-free rate is going up? It's not the real rate, it's the inflation rate. So if we're expecting interest rates to go up, what we're essentially saying is we're expecting inflation to go up. The liquidity preference theory says that it's harder to get people to lend you money long term than short term. And since there's more risk in lending money long term, we have to compensate the people that lend us for long term. So the liquidity preference theory says that the yield curve will normally be upward sloping just because it costs more to borrow long term than short term, because investors want compensated for additional risks. And finally, market segmentation just says that there are times when investors, whether it's due to economy, their industry, a variety of factors, there are times when people want to invest in different time frames. So supply and demand will also have an impact on the time frame, on the yields. The more people want a specific yield, right, the higher the return is going to be. Obviously the lower the price. Everybody wants more, so it's going to drive the price up. So that's going to drive the return down. So now we could possibly have a yield curve that is not upward sloping at all. It could have some humps in it, or it could have some abnormal shape to it, if you will. So we have to look at these three segments, these three theories of what create the shape, and try to understand what's going on in the interest rate world. So what does it mean? Upward sloping yield curves result from higher expected interest rates, a preference for short-term loans, and greater supply of shorter-term loans. All of those things will have an impact on the yield curve. And of course, flat or downward sloping is the exact opposite of that. Well, the next part of this chapter then we will discuss how you calculate yields, and we'll also look at some risk elements and strategies.